G'day, welcome to Lunch Money, your online and social media home for workouts, special situations and capital raising professionals. My name's Nick Samios. I am the fund manager and director here at Hermes Capital, and I'm your Lunch Money host. Today, I thought we would dive in and have a look or check in on the property market. The property investment has been in the news this week with the Treasurer, Josh Frydenberg, coming out and saying that he's going to give support to the regulators to somehow crack down on lending in the home loan or in the home sector. What exactly that might look like, we're not 100% sure. It might look like something to do with servicing ratios, how much, how many multiples of your income you can borrow. It might have something to do with LVRs, and there's certainly talk of that dampening the market. I heard Mark Burris this morning saying that he was concerned that it might be a little bit too much too soon. And there was also, I saw the Finance Brokers Association also came out saying that they sort of wanted to be more targeted than more general, but we don't know exactly what that's going to look like. But certainly, it's brought property back into the spotlight, and it raises the question once again: are we in a property bubble? My wife got an SMS this week from a real estate agent saying, "Listen, put your property on the market now because soon the international borders are going to open up, and people are going to be spending their money on travel instead of new property." And referencing these new measures that the Treasurer was talking about this week, and so saying that it was good time to sell. So I thought we've got two people coming in today to speak with us. I've got Luke Egan, who is the director of Aster Alliance, and I have got Josh Twelftree from Essentia Property. And I'm going to start off by introducing Josh Twelftree. G'day, Josh.
Thanks for having me on the show.
You're right. Listen, I thought a good place to start is you're with Essentia Property, and Essentia Property is your own business. You've just started that. You were at CBRE Asia Pacific for some time. Obviously, CBRE is an international property group. Tell us, just by way of introduction, about your journey from big international corporate to where you are now, and why.
Yeah, so Nick, I started off at CBRE. I was there for probably a good 7 years, 6 to 7 years. And while I was there, we carved out a bit of a niche sales team whereby we just focused on healthcare and social infrastructure property. So that being healthcare, aged care and childcare. We built quite a large business there, obviously building up some very good contacts in that space. And left about 6 months ago and decided to start up my own company with a business partner, Clay Trembath, who came out of Charter Hall. He was in the childcare fund there. So basically, we have now started up a company where we are in that transaction space, both healthcare and a lot of childcare as well. So we do a few off-market sales. We do a fair few leasing opportunities and transactions, and also we're starting to do some developments as well, probably more so focused at the moment in that childcare space because there's a lot of activity both from investors and operators as well at the moment.
So who is your client base generally? Are they funds? Are they private investors, banks? Who normally engages you?
Yeah, so from a transaction perspective, with the sales, they are a lot of large funds out of probably a majority are based in really Sydney, but the likes of Australian Unity, Dexus, Barwon, RAM, there's probably a good dozen at the moment that we deal with, in particular in that healthcare space. And they're basically focused on transactions that are in excess of $10 million in that healthcare space. So we do a lot of work with those groups, trying to find them properties to buy. And then in that childcare space, that is growing heavily in that institutional space again. So what we're seeing is we're seeing a lot of institutional clients that used to buy healthcare are now focusing on buying childcare as well, because they see basically how much it is an in-demand sector. They've got the ability to get some scale in terms of purchasing assets, and also it's an essential service asset class, and that's just gained more and more popularity during COVID, especially.
So is this something that's become in vogue recently, or has this been something that's building up? I mean, there's so much money circulating around the place. These funds are chock-a-block full of cash. Is it just now that everyone's now flooding into childcare, or it's always been a fairly hot area?
No, it's really come to the forefront probably in the last year. There has been some larger funds that have been acquiring childcare for the last 10 or so years. People like Arena, people like Charter Hall, they're still very big in this sector. They've always been in it, but now we're seeing a lot of new market entrants. And with healthcare, that's been, again, probably a lot. There'll be half a dozen major funds that have been purchasing healthcare for the last 5 to 10 years, but now we're just seeing more and more come into that space, and that's obviously driving prices for healthcare and childcare assets as well.
And what are you engaged when someone's looking at an investment and they say, look, guys, can you come in and kick the tires and do an assessment? Or is it when they're looking for something, they're saying, look, we've got this fund here, it's been set up to do X, Y, Z. Can you find us some opportunities? What's the nature of the engagement?
Yeah, so we do both. So from that institutional healthcare perspective, basically they come to us and say, can you help us acquire assets? And a lot of the time we have connections with the owners in that healthcare space and are able to source opportunities for them. Then on the flip side, in terms of the operators, so we do a lot of work with childcare operators looking for new opportunities and looking for new locations to be based in. And what we'll do is we'll go then and try to source them sites. So that's a large part of our business now is looking for properties that are suited to childcare. And then once we've got those properties, we can go to the operators and say, hey, have a look at this. This has the right demographics for childcare. So that's a big bulk of our business now because there's just so much activity in that space.
Okay. All right. Well, look, Josh, we might just pop you back into the waiting room there and introduce our other guest for today, Luke Egan from Aster Alliance. G'day, Luke. Thank you very much for coming back again.
Thanks for having me again.
Very, very good. Now, so now Aster Alliance is a property advisory of a slightly different nature. A lot of the stuff that you do is involving dealing with mortgagees and lenders and helping with distressed property. What is it that's taking up your days?
Yeah, look, I mean, everything going on in the property at the market at the moment, we're obviously not as busy as we should be, but we're definitely starting to see some changes in the marketplace at the moment. What you mentioned earlier around interest rates and so forth, and some of the regulators coming in and changing some of the things might be happening in the banking area. For us, it's just incredible. I'm going to concentrate on the residential property market at the moment, but we're doing online auctions for mortgagee sales at the moment, and we're getting 50, 60 registered bidders who are bidding online, and in some cases we're getting 600 square metre blocks up to 1,000 square metre blocks in middle class sort of areas in Western Sydney and Western Melbourne, and we're going over $100,000 to $200,000 over reserve. The appetite is just incredible out there at the moment to purchase property. A lot of people out there who have equity in their properties, they're looking to become builders in their own right. We're seeing a lot of renovations, small renovations right through to small developments of units and townhouses. So yeah, the appetite's very big out there at the minute.
And what? So are these properties that you're helping get to market that are distressed, and they're like residential developments, that sort of thing?
Yeah, we specialise in the distressed area, so it could be it's a broad area. It's a blend of industrial, commercial, retail, residential. But the majority of the distress work we're seeing at the moment is in that residential area, specifically around apartments, small developments, and also a bit of retail. Areas like industrials are still very strong, so we're not seeing much recovery work in that.
But the apartments are still hot, you're saying?
Apartments aren't. So if you look at some of the figures around Melbourne specifically, apartments in Docklands, South Bank, Carlton, they're down about 30%. We're talking about residential homes and townhouses, which is where the market's hot at the moment. Units is an area for concern in the marketplace, specifically in Victoria.
Right. So these things they're already in distress, some of these developments. And where are you picking them up? Are these completed developments, or are you picking them up when they're half built and you've got to help finish them off? Where are you getting engaged?
Majority of it is where a builder's probably at fixing or lock-up stage, and where they've run out of capital. And that's where we would usually come in and assist with that, either as an external project manager to get the build complete, or step into the shoes of the builder and complete under our own permits. But we're also seeing a lot of people who are doing land banking and applying for planning permits and building permits and defaulting at that stage as well, as they don't have any income coming in on the assets. But to answer your question, it would be around builders not having the ability to complete their projects, whether that's due down to funding or down to their delivery model.
And are they with banks or private lenders predominantly?
It's a blend. It's a blend. It would be non-banks. There are some institutional banks that we're also doing work for, but also in the insolvency market as well. So bankrupt estates or corporations entities that may have entered into some contracts with some development sites, and we're acting on behalf of the practitioner.
Yeah, I must say, having a look at the insolvency notices every day, in most of it seems to be mainly property related. I don't know who the companies are, but you look at their names and you can guess they seem to be either SPVs for developments or, builders in this, mainly in the third tier and lower sort of space, it seems to be. Okay. All right. Well, look, we will bring Josh back. And we'll just talk a little bit about, we had a headline there, it may have been from today, about childcare centres and the yields that they're getting. Childcare centres sell on record low yields. So I can buy a childcare centre and get a return of, this one was, I think it was 2.99%, which to me, that does sound a little bit remarkable to me. Josh, is that a new record, or what? I guess
yeah.
Can you talk us around that? What's going on there?
I probably wouldn't be buying it either at 2.99%. But I think the reason why that would have transacted where it did is there's probably two main reasons. The first being the price point. Around that sort of price point, you've got a lot of mum and dad investors and high net worth privates. And that's obviously going to fuel competition. If this was an asset probably north of $10 million, they're going to drop away, and it'll only be your institutional groups that would be looking at it to purchase. That would probably result in a bit of a softer yield. And obviously in that institutional space, they need to justify a lot of the time to their board as to why they're paying the price that they are. And that's just not going to get valuation support in today's market. And the second reason why that transacted where it did would probably be the location and the underlying land value. In a lot of these built up and established areas, childcare is very popular, and especially if there's a high median house price, because the barrier to entry comes into effect. Obviously, it's very expensive probably to buy 3 houses side by side, knock them down and put up a childcare centre. So investors have a lot of confidence that if they buy this childcare centre, that they're going to be there for the next 10, 20 years, and there's not going to be too much competition coming into that area.
So that's interesting. You're saying it's almost two different marketplaces there. So there's one that's accessible by mum and dad, maybe through their self-managed super fund or whatever it might be, and because they're desperate for yield, like everybody's desperate for yield, they might be comfortable to overpay, it were, which drives that yield down. But once you get into the bigger tickets, you've got professional investors who who are running a whole bunch of different analytics and metrics over it, I suppose.
Yeah, absolutely. And you'll find that in that smaller mum and dad high net worth private area, there's just more and more buyers coming into that pool, and that's purely driven by, I think, the good news that childcare has been getting lately in terms of the government and how much support they've been giving these childcare centres during COVID. It really does just highlight that it is a sector where it is essential, and basically it is the driver behind the Australian economy. And when the government's tipping that much money into the sector to keep it afloat, it certainly says something about how crucial it is, which is why investors are really coming into the sector hard, because they see how important these centres are, and they're hopefully going to be there for the next 20 plus years.
Okay. Luke, are there any other sectors that you're seeing these sorts of characteristics, or well, let me ask you a different question. When the phone rings and you've got, whether it's a bank or a mortgagee that's got a distressed property, are there any sectors that you go, you beauty, like, for example, childcare, I can really do something with this because there's a lot of hot money for it? What are some of the others, or is most of it the residential stuff? Or
no? So obviously myself and Josh have a relationship in real estate, and we're always sharing leads. Some of that childcare stuff that what Josh was saying before, it is extremely hot at the moment, whether it's for a fund or any other buyers out there. I think similar to that, we're seeing aged care and retirement living is definitely hot. We don't see a lot of distressed stuff in that area, but it's a market where if there is assets available or property available, it is very much quick to move off the market. I'd say the same for industrial. It's just a booming sector in general. You look at the amount of work that Charter Hall and Australand and the land that they're buying. Anything in those areas is just hot, and it's purchased and snapped up pretty quickly.
Mm.
Okay, well, just to change the tone, a little bit earlier, Luke, you were talking about the supply chain, and you were saying that there's some issues there holding up developments. Do you want to just talk a little bit more about that?
Yeah, well, there's an extreme shortage at the moment in Australia in general for steel and timber. I think September we hit the peak of a shortage. So this is a flow-on effect onto a lot of commercial and residential building projects around the country. It has slowed down projects in line too with COVID, with all the restrictions with having labour on site. So a lot of these claims that would have been put in by builders have had to been slowed down, and work hasn't been able to be completed to time frame. So then you've got liquidated damages and LTIs coming in place as well. So it's a big flow-on effect, and that's going right from the top to the developer, right down to the tradesman on the ground. Everyone's feeling the impact of that. Fortunately, I believe we're coming out of it now with our supply. September was probably the hardest hit. October, we're due to increase our production, and we're going to have more access to materials. I guess from a building perspective, on a lot of these development sites and project sites now, is getting the labour back on site. I mean, we've seen footage of what's been happening in Victoria, and it's been absolutely devastating for the industry down here, not being able to get tradesmen to site, and then the flow on from that. The impact that it can have on a lot of these businesses is substantial. It's not just the time out on site. It's the back office. It's the planning. It's the programming. It's the estimating that goes into all this work. And these stop-start delays are definitely impacting a lot of people in the market.
Yeah, I guess like everything, there's always seems to be mixed signals. I've got one of the headlines there. Surge in jobs powering budgets, $80 billion rebound. So you'd look at that and you'd say, well, when all of these tradies in Melbourne, for example, that you're talking about, when they can get back on site and they start building, if the economy is going to swing back, then property prices may stay hot. If on the other hand, if I'm just wondering if all the activity ramps up again and we've got supply issues now, what happens when everyone's back on site and ordering supplies again? What happens then?
It's a great point, and we'll find out soon enough. But I believe the supply for materials should improve, but labour requirements is definitely going to be a struggle. There's just not enough labour to do the amount of work that's out there in the moment in the different sectors, and we're going to have to fill some gaps in to make these projects get completed on time and on budget.
Okay. So Josh, we've talked about childcare, and it's a hot sector, but your other one of your other specialties is healthcare, you were saying. So what are the dynamics there? What's going on in that sector?
Yeah, healthcare is, in terms of sales, again, that's the yield compression that we've seen in healthcare in probably the last couple of years is, you would probably see it compress around 100 basis points, 1%. And the reason being is that there's a lot of new funds coming into that sector driving prices, funds that are looking to list. You may have seen in the news, HomeCo have listed HealthCo. They are, a client that we work with and try to source them opportunities. But that's a prime example of someone with a lot of capital needing and wanting to buy these healthcare assets, and they're paying some very big prices. Centuria Heathley are another group that are out there and quite aggressive at the moment. So there's just a lot of activity from the larger groups wanting to acquire. And then again, from your mum and dad investors, probably similar to childcare, they see healthcare as an essential service asset class, something where, they're happy to tip their money into, knowing that you're always going to need a doctor, you're always going to need a dentist, you're always going to potentially need a childcare centre, and that just gives investors a lot of confidence. From an operator's perspective, healthcare is not as active as childcare at the moment. There's probably not that many groups that are looking to really expand and open new locations, and the reason being is that getting the doctors is very difficult. So it's extremely hard to attract these doctors, and at the moment, obviously, they can't bring them in from overseas. So that's putting a halt to a lot of these healthcare groups wanting to open up new locations. So that's putting a hold on that sector.
Yeah, that's interesting. I'll just remind people watching live that I've got this mug for you. If you ask us a question live, you can tap in on your LinkedIn or your YouTube or your Twitter or whatever it is, or your Facebook, and fire a question into the boys. And we'd be very glad to take them. It's interesting, Josh, you mentioned it's hard to get doctors. I mean, and Luke, you were talking about, labour shortages as well. I was talking to someone yesterday who's, in an IT firm, and they're looking for 20 people. But normally, under normal circumstances, we've got, educated, skilled and unskilled people, flooding into the country on any given day of the week. So, starting off with you, Josh, I mean, how is that impacting the sector? And I guess when the borders open, are we going to see a lot of change? Are you plugging that into your modelling at all?
Yeah, I think when the international borders open, you'll see a bit of a change, and I think these groups will start becoming a little more active. But yeah, what we're seeing at the face of it here is that, the only way for these healthcare groups to open up a new greenfield location is basically they'll have to buy some surrounding GP clinics just to be able to bring the doctors into this new facility. So yeah, there's a big shortage for GPs, and look, a lot of the time they don't want to travel either. They want their clinic to be close to their home. So that's a big thing on their wish list when these healthcare groups come to us trying to help them find sites. They basically said, we're looking for locations now that need to be near affluent areas, because that's where a lot of the doctors live. So that's a big draw cut actually for these healthcare groups and finding sites for them now.
Okay. So Luke, we already talked about the labour shortage on the residential and other sectors in the market, certainly in the building part. I mean, it's one thing to try and find doctors to actually, as bums on seats in these healthcare centres, but it's another thing to find people to build them. I know that just around the corner here, there's a lot of road work going on, and there's a lot of the paddle pot people, the traffic control people, and there seem to be a lot of very thick Irish accents down there. So either they got locked into the country or they're getting in somehow. But I mean, is it something that's talked about? I mean, how do they solve that problem?
Yeah, property, like Josh's industries, very, very much reliant on international workforce. And obviously that's dried up a lot. A lot of these civil infrastructure projects have sucked a lot of the labour away as well, which is making it harder on other industries. It's big talking points with the REIV, master builders, in certain areas of property on how we're going to plug the skills shortage. There are programs which are encouraging people to leave school and to become, whether it's a trade or look at some sort of business course to go into the real estate property markets. But it's a big challenge, and I think it's going to take a while to try and find a solution. But yeah, we're just gonna wait and see what happens when the borders open.
Mm.
Now, Luke, you've sort of in a very unique spot because you are both a builder as well as a consultant to financiers and lenders and investors, etc. I mean, how do you see? What in your crystal ball? What are you seeing early next year? I mean, are you seeing things remaining hot? You're talking to the people. You're ahead of the curve because you're talking to people who are, got stuff coming out of the ground, and so you're able to get a little bit of insight ahead of a lot of us. I mean, are you concerned that is the market overheated? Do you think the government is overreacting by trying to curb lending, or is this something that they need to do? We've had this 20% increase. They're saying next year it'll only be 7%, which should be sort of pretty big in normal circumstances. I mean, are you seeing a collapse? What do you think is going to happen?
Look, we're not going to see a collapse. I guess, as you said, it's a niche industry, and I got into this industry back in Australia through doing a bit of this over in the US, specifically in New Jersey and Dallas, working in that subprime market, buying and flipping property. And there are some big parallels between what did happen over there and what's happening in Australia. Not from a lending perspective, but where we're a lot more tight and examining our loans and what we're doing for funding. But the property prices over in the US and what's happening here now are very similar. The year-on-year growth, it was all 15 to 20%. There was a lot of construction happening around the country at any one time. Oversupply did become a problem over there. I don't think we're going to have that issue here. But you got to remember also the last 18 months to 24 months, the large financial institutions haven't enforced any of their loans. The backlog of recoveries is going to be huge. Now, non-bank lenders, they're still enforced. They're not under the same regulations as some of these bigger lenders. But early next year, my view is that we're going to start to see a bit more enforcement across a lot of the larger banks, and I believe that will flow on if there is an interest rate hike. If APRA do get involved and start regulating the industry a bit more, I believe the market will cool a lot.
I've just got a query over that, Luke, because yes, on one hand, the banks aren't enforcing; they're not taking any action at all. And some people say that until the Australian Tax Office starts to crack down on people, the banks are just sitting on their hands. Interest rates are so low. I mean, cash is virtually cost nothing, so it's not costing anything for the banks to sit on bad debts. It's not like they're eating their heads off with a huge capital cost. But I think there's so much private money and institutional, non-bank money around. I just wonder how much of the bank's problem loans have migrated off bank balance sheets and into funds and into private lenders. I wonder, when interest rates do go up, and when the party does come to an end, I just wonder whether or not the banks will be sitting there having offloaded effectively onto private investors and to funds. I mean, what do you think?
Yeah, look, I think it's a very valid point. I mean, the banks have got a lot smarter since the GFC. They've set up these workout departments around what you were just talking about then. So maybe they have been on the front foot, and we are going to see a lot of these loans being pushed down the road and refinanced, which could hold home prices up. But my view still would be, though, with the amount of enforcement that's been done over the last 18 to 24 months, I still think there'll be a steady flow of recovery work, and I think that will flow down the chain. And if there's an impact with interest rates, and like I said before, with APRA getting involved and the regulator, I think the market will cool, and I think it has to. How we're selling property at the moment, we've got 50 to 60 people who aren't even physically viewing a property and paying $100,000 to $200,000 over reserve.
Well, can we just? That's interesting. Again, my wife told me this week, about 2 properties in the area that sold for crazy prices, and they didn't even hit the market. Or if they did, they just sold straight away. I don't know if people are viewing them. So when you're talking about 100,000, 200,000 over reserve, you're talking about apartments presumably that would be expected to get what, $1 million? I mean, what's the expectation? What's this 100 over? What just to give it some context?
So it's not apartments; it's residential dwellings. Something with 600 to 1,000 square metre block, 3x1, or a townhouse.
And people are buying them sight unseen, effectively, except for a nice walk through on a.
We are running Zoom auctions, or we're doing expression of interest, and no one can physically step foot in these properties, and they are receiving bids left, right, and centre. The demand is huge, and they are all selling. I mean, our clearance rate at the moment is sitting at about 96%. And the only ones that we're not selling is probably residential apartments. Everything is just going.
Yeah. Okay. Wow. And Josh, are you with the funds that you're speaking to? Are they just throwing all caution to the wind, or what advice are you giving them to make sure that they're not overpaying or not over investing in these sectors, in these properties?
Yeah, we try not to say too much. We obviously want the deal to go across, get it across the line, but probably very similar to what Luke was saying, that a lot of these funds, they know what they can pay. They speak with valuers every day. They've got fantastic skill sets, and basically 100% of our properties that we sell are done off market, and very similar to Luke, that a lot of these funds are based in Sydney. They won't come and inspect the property at all. They'll just put forward an offer. They'll have probably someone locally here in Victoria go and do a building report, and a valuer go through the building, and then that's basically it. The property's transacted. And a lot of the time, the owners of these investments don't want all that public exposure anyway through a sale campaign, because sometimes that can affect the operating business that is there. Obviously, if there's a big for sale sign up at the front of the property, a lot of the time people think the business is for sale as well, and it can get the tenants offside. Right.
And I guess all the mum and dads doing kiss and drop, start looking elsewhere, do they? Or
absolutely, yeah. They get worried that the childcare might be changing hands, and they start to get worried. It happens a lot in that healthcare space also. So, and aged care, you won't see many signboards, if any, out the front of those properties, because when the residents see them, it doesn't do the business any favours.
Right. Okay. All right. Okay, guys. Well, look, we are just sort of coming up against the clock. So I might ask you just a bit of a question out of left field. And I'm sorry I didn't prep you with this one, but just off the cuff, I'll start with you, Luke, and give you a little bit more thinking time, Josh. If you were the treasurer and you were trying to take the heat out of the property market without crashing it, I mean, what would you do? How would you go about it?
Oh, it's a very very tough question, Nick, to end. But I would probably I wouldn't put interest rates up, number one, and I would toughen up the criteria for lending in regards to multiple investments and so forth.
Yeah,
that's probably
so something that's going to impact the investment market, not the home buyer.
Not the home buyer.
Okay. All right. Look, I mean, none of us are economists here, but you know what? The economists haven't got a clue either. So may as well be people that are actually, sleeves up, working in property every day. What about you, Josh?
Yeah, I'll probably say that I'm not an economist, so I'm not too sure, Nick. But no, look, I think from a commercial perspective, I don't see it heading down the path anyway in terms of what these capitalisation rates, what's being paid at the moment. I think we're right at the top of the market personally, and I don't see it going, these prices getting any higher, or these cap rates getting any sharper. So I think we're right at a peak, and if anything, it might just slightly come up the boil in that healthcare and childcare space. It's just the only major issue is that there's not many opportunities out there at the moment for these funds to buy. So, and when they are in the market, they're highly sought after. But I personally don't see these cap rates getting much sharper.
Well, the interesting thing, Josh, is that 2.99 as a cap rate versus 0 is only 2.99. But the way that the US are about to drop a $3.5 trillion spending package, and most of that I'm sure is going to come from printed money. They're printing money like crazy around the world. We are seriously still staring down the battle of negative interest rates. So if interest rates are a -1% or -2%. 2.99, I suppose, starts to look, pretty red hot. But anyway, look, we'll leave it there. So Josh Twelftree, thank you very, very much for making the time to come and chat with us, and all the very best on your journey as a principal. Welcome to the club. It's all beer and Skittles, I can assure you. Yeah, and Luke, thank you very much for coming along once again. And
thanks for having us again, Nick. Absolute pleasure.
Been really good. Okay, well, thank you to everybody who's been listening, either live or later on off the podcast. And we'll do it all again next week. Cheers.